All right, let's dive right into this explainer. We're unpacking a massive paradigm shift that's completely redefining the 2026 market. I mean, we're literally watching the old rules of hypergrowth get rewritten right in front of us. And honestly, it's catching a lot of everyday investors totally off guard. The market is sending a really loud, crystal clear signal about what it values most right now, and it's turning everything we thought we knew about investing upside down. Think about it. For the last decade, we were basically trained to believe the only way to build massive wealth was chasing the hottest new tech, right? Finding that next huge disruptor. But the data we're looking at today, it tells a completely different story. We're going to break down why historical data shows this huge pivot back to established brand names and durable consumer habits, and what that actually means for your portfolio. So, I want to start with a kind of jarring paradox. Why on earth is a donut chain worth $20 billion right now, while AI tech companies are crashing? It's wild. We have this situation where these once vaunted, high-flying tech startups are aggressively firing staff just to try and squeeze out a profit. Companies that promise to revolutionize the cloud, like CoreWeave, are missing their forecasts and burning through capital at an alarming rate. And meanwhile, a company that does nothing more complicated than selling a cup of coffee and a glazed donut is confidently prepping to go public at a staggering $20 billion valuation. It feels totally backwards, right? You'd assume the cutting-edge tech companies should be the market darling, and the brick-and-mortar fast food chain would be struggling. But the underlying mechanics of today's economy have violently flipped the script. And that brings us to the core thesis from our sources today. In 2026, boring is the new exponential. What we're witnessing across the financial sector is a massive, panicked flight to safety. Look, after years of persistent inflation just eating away at wallets, consumer sentiment has plummeted to record lows. The cost of living has skyrocketed, and people are exhausted. In this kind of environment, institutional investors, they aren't looking for a pipe dream 10 years down the road anymore. They absolutely do not want to hear about AI taking over the world by 2035 if the company can't even pay its server bills today. They're demanding absolute, rock-solid certainty right now. And it turns out, the most certain thing in an uncertain world is human habit. Buying a coffee every morning is a boring, predictable habit. But right now, predictability is literally the most valuable asset on Wall Street. So here's our roadmap for this explainer. We'll start with why boring is the new exponential. Then we'll do a quick breakdown of coffee versus code. After that, we'll look at the real value of free cash, unpack private equity's master plan, and finally, we'll go over the retail lockup trap. Let's jump straight into that first point. Boring is the new exponential, and this massive flight to safety we're seeing right now, driven by geopolitical instability, especially the ongoing US, Israel, and Iran conflict, oil prices have been kept artificially high. Currently, Brent crude is projected to stay well above $80 a barrel for the foreseeable future. And this persistent inflationary pressure has created what economists call a K-shaped consumer strain. Imagine the letter K. Higher income households on that upper arm, they're still spending. Their stock portfolios might be up, their homes have retained value, but lower income consumers on the downward arm of the K are stretched to the absolute breaking point. Rent is up, gas is up, groceries are up. Because of this massive economic fracturing, institutional investors have officially declared the death of the growth at all costs era. The days of throwing cheap money at unprofitable startups just to capture market share, those days are totally over. And the sheer, unrivaled scale of the solution the market has found is pretty incredible. Enter Inspire Brands. This is the massive corporate ecosystem that houses Dunkin', Buffalo Wild Wings, Arby's, and Sonic. We're talking $33.4 billion in global system sales across more than 33,300 restaurants, with digital sales making up a massive $11 billion chunk of that revenue. But here is the real secret to their valuation. They operate almost entirely as a franchisor. That means Inspire Brands doesn't actually buy the chicken wings, they don't pay the daily wages of the barista, and they don't directly absorb those devastating risks of labor shortages or food inflation. Instead, they just sit back and collect highly predictable royalties from thousands of independent franchisees. It's the ultimate hedge against inflation. It turns the habit-based demand of selling millions of daily coffees into a highly prized, risk-adjusted cash machine. Which leads us to part two, coffee versus code, and the contrasting fundamentals driving these markets. This right here is the ultimate alpha in today's market. On one side, you've got the coffee model, perfectly represented by Dunkin'. It boasts incredible predictability. We're talking 20 consecutive quarters of growth, operating on a 99% franchise margin model. It's steady, it's reliable, and it practically prints cash. On the exact opposite side is the code model. Think of AI neocloud providers like CoreWeave, who are trying to build the infrastructure for artificial intelligence. They suffer from wild volatility and an extreme life-or-death dependency on depreciating hardware. I mean, they have to constantly buy high-priced GPUs from suppliers like NVIDIA just to stay relevant. So one model requires almost zero capital to grow, and the other requires billions just to survive.
To put that into perspective, consider this staggering metric. To generate just a single dollar of sales, an AI infrastructure startup like CoreWeave currently needs $2.60 of capital expenditure. It's an incredibly brutal financial reality. It's literally like having to put almost $3 into a vending machine just to get a $1 bill back. You have to constantly build data centers, power massive cooling systems, and upgrade processors every single year. Now, in a low-interest rate environment where money is basically free, investors will tolerate that. But in a world where interest rates are staying higher for longer, that cost of capital is absolutely devastating to the bottom line. The debt required to fund all that infrastructure eats away any potential profit long before it ever reaches the investor. And the result? A negative $7.3 billion in free cash flow for a single year for CoreWeave. That is a jaw-dropping number. And it really drives home exactly why the market views the AI infrastructure industry as an unquenchable furnace right now. Sure, the top-line revenue growth is technically there, but the cash is just burning away faster than they can shovel it in. Institutional investors look at a negative $7 billion cash drain and realize, hey, this company is going to have to constantly go back to the market to raise more money, which just dilutes the shares of existing investors over and over again. When capital is expensive, burning billions of dollars to chase future growth is a fundamental red flag.
So let's move to our third point, the value of free cash and why we're totally revaluing consumer staples. The underlying technical valuation metric that's currently driving billions of dollars of institutional capital away from tech and into consumer staples is called free cash flow yield, or FCF yield. Basically, it measures the tangible, spendable cash a company generates relative to its total market valuation. It's actually very closely aligned with what legendary investor Warren Buffett calls owner's earnings. Think of it as the actual money an owner could pocket at the end of the year without hurting the future operations of the business. In our current macroeconomic environment, tangible cash today is infinitely more valuable than speculative earnings projected a decade from now. I mean, if you can guarantee me $1 today, I'm going to pay premium for it, rather than hoping you might make me $10 in 2036. Calculating this yield is surprisingly simple, but it reveals everything you need to know about a company's health. First, you take the operating cash flow. That's the pure money coming in the door from selling products or services. Then, you subtract the capital expenditures. This is the crucial part. Capital expenditure is the money required just to keep the lights on, fix broken equipment, and maintain the business. Finally, you divide that remaining pure cash by the total market capitalization, and boom, that gives you the yield percentage. Because Dunkin' operates an asset-light franchise model where the local owners pay for the new espresso machines and the building repairs, corporate maintenance costs are incredibly low compared to the royalty cash flowing in. That sends their free cash flow yield through the roof, making it a huge beacon for defensive investment. All right, on to point 4, private equity's master plan and how they're strategically cashing out the high multiples. Now, the crucial thing to understand here is why Inspire Brands is choosing to go public right now, in this specific economic climate. The private equity firm behind them, or Capital, is running a highly calculated master plan. Right now, quality and stability are commanding an absolute premium in the market. Everyone wants defensive stocks. Roark is deliberately offloading these assets now to capture those peak valuations. But why the urgency? Well, because they're currently sitting on a heavy 6.4 times net debt to adjusted EBITDA ratio. In plain English, they have a massive amount of debt relative to their actual cash earnings. And in a high interest rate environment, carrying that much debt is incredibly expensive. So they plan to use the estimated $2 billion in IPO proceeds to aggressively pay down their term loans. They're basically using the public market's desperation for safety as the perfect exit liquidity to clean up their own balance sheet. Which brings us to our final point, the retail lockup trap and how you can survive IPO fever. Look, historically buying into mega IPOs on day one is a really dangerous game that almost always burns the everyday investor. Back during the dot-com bubble, a company called VA Linux had an IPO where the stock spiked a legendary 697% in a single day. The headlines were euphoric, right? But here's the brutal truth of that historical data. That massive gain was captured almost entirely by institutional traders, banks, and insiders who got in at the pre-IPO price. Everyday retail investors were completely frozen out until the price was at its absolute peak, right before it collapsed. Catching IPO fever and buying on day one of a $20 billion mega IPO like Inspire Brands is incredibly dangerous, mostly because the system is structurally designed to benefit the insider selling the stock, not the retail investor buying it on opening morning. The mechanics of an IPO are designed entirely against the everyday investor. Day one is pure fever and a price spike driven by media hype. Then, for the next 6 months, from day 1 to day 179, the stock has artificial support. That's because private equity insiders, early investors, and employees are legally locked out from selling their shares. The supply is artificially constrained, which keeps the price propped up. But on day 180, that lockup expires. The market immediately gets flooded with a tidal wave of new supply from insiders who are finally cashing out their millions. Predictably, this massive wave of sell orders inevitably drives the price down. Mathematically speaking, waiting out this 180-day period and buying the dip after the insiders have sold is pretty much the only sound, data-backed way to play a massive IPO without getting caught holding the bag for private equity billionaires.
So, wrapping this up, the core lessons from our sources today provide a super clear playbook for navigating this complex market. The 2026 strategy is completely focused on defensive fundamentals. Number 1, prioritize durable brand moats. You want to look for things people buy out of pure habit, regardless of what the economy is doing, like that morning coffee. Number 2, seek out asset-light, predictable cash flows. Definitely avoid companies with unquenchable capital expenditures that have to burn billions just to stay afloat. And number 3, strictly avoid the 180-day IPO lockup trap at all costs. Let the institutional hype cycle play out, wait for the insider selling pressure to clear, and approach the market with a cool head. Because right now, this simple, boring act of selling consumer staples is providing the absolute most resilient path to profitability. I want to leave you with this provocative thought. If the simplest businesses, a morning coffee, a quick drive-through, a household staple, are currently creating the most exponential value in the financial markets today, what other boring habits in your daily routine are quietly worth billions? What products do you blindly purchase every single week without even thinking about it? Start viewing your own life and your own spending through the lens of free cash flow yield, and you just might spot the next massive defensive megatrend long before Wall Street does. Thanks for joining me on this explainer. I'll see you next time.